The Canadian market is seen as a stable, well-regulated, and valuable component of the global financial markets. However, being neighbors with the country with the largest financial markets comes with some disadvantages. The major one being that our very own Canadian stocks don't get enough attention in the news and social media. So in this video, we are going to look at some of the most popular stocks in Canada right now. When I say popular, I mean some of the most active stocks that are being traded right now. We will also pick a few of them and look at them with a closer lens. Before we begin, my name is Rohan, and over the last few years, I've spent thousands of hours learning about personal finance and investing. Now I'm sharing some of my learnings to save you some time and fast track your financial journey. With that out of the way, let's get to the stocks. First, we look at a list of the most popular stocks in Canada right now. Being popular means these stocks are highly active and have the highest trading volumes in the Canadian stock markets. By the way, I'll be using TradingView to show you the most active stocks. I use TradingView for most of my needs. I find it to be very useful and it offers a lot of features considering it's a mostly free platform. So now here's the list. It's no surprise that we see a lot of known names on the list. We have some of our most popular banks, Scotiabank, TD and RBC. We also see two of the biggest insurance companies, Great-West and Manulife. And of course, we have our energy companies, Enbridge and Suncor. In this video, let's focus and take a deeper look at Manulife, Enbridge and TD. And don't worry, this list doesn't change a lot, and over time we'll take a closer look at all our favorite Canadian stocks. For now, here are the reasons I chose these three stocks. They represent three different industries: insurance, energy and banking. They all have a long history and pose lesser risk long term. They're also all high dividend paying stocks, and they are looking quite attractive at the prices they are at right now. First on the list is Manulife Financial, ticker MFC on the Toronto Stock Exchange. Manulife is a leading international financial services group specializing in insurance, wealth management, and financial planning. They offer products and services related to life insurance, health insurance, investments, and even retirement planning. The company is headquartered in Toronto, however, it operates globally. It has significant presence in Canada, United States, Asia, and some other international markets. So they are serving millions of customers across the globe and helping them secure their financial future. Taking a closer look at the revenue breakdown, we see that their business in Asia is far bigger than the North American and other international regions. Now let's take a quick look at the company financials. As of August 22nd, the stock is trading around $24, down about 2% year to date. The market cap sits around $43.6 billion and their price to earnings ratio is about 8.5. It's pretty great because the sector average sits around 11.5. Now here's the fun part, the dividend yield sits around 6% right now. Manulife has paid dividends for 22 consecutive years, with the sector median sitting around just 10 years. But that's not all, the dividend has also grown over the last 9 years. Again, this is amazing compared to the sector median. Even the dividend payout ratio sits around a healthy 48.45%. The TipRanks analyst consensus currently shows hold. However, they are also projecting an upside of about 25% with a price target of $30 in the next 12 months. The fundamentals also look pretty positive, and generally speaking, it's not a very divisive stock. It usually sits in a very neutral territory. Manulife has actually been a part of my dividend portfolio for a while now, and I've also added to my positions in my RRSP over the last few weeks. Manulife tends to be a Canadian favorite when it comes to dividend investing, so make sure you take a closer look at it. Next on our list is Enbridge, ticker symbol ENB on the Toronto Stock Exchange. Enbridge operates in the energy sector. Its primary focus is on energy distribution and transportation. However, they have also entered the renewable space, especially wind energy. They have pipeline transportation, oil storage, and natural gas distribution. They are also increasing their investments in wind farms. Enbridge is headquartered in Calgary, but their operations span across North America. They have significant presence in Canada and the United States, but recently they have also started expanding into the European markets. When we take a closer look at the revenue breakdown, we see that the largest portion of the revenue comes from energy services. This is what we just spoke about, the supply of oil and gas. Pipelines also form a significant portion of the business, and even though the renewable power generation looks like a tiny sliver right now, they are rapidly expanding in that sector. Now taking a closer look at the financials, we see that as of August 22nd, Enbridge was trading around $46.50, down about 12.5% year to date. The market cap is about $95 billion and the price to earnings ratio is just over 25. Yes, I know it looks high, and indeed it is high compared to the industry average, which is around 10.3. But what makes Enbridge so appealing and active is the fact that it pays a dividend of 7.55%. And talking about dividends, you'll see that they have paid and grown their dividends consistently over the last 8 years. Now you're starting to see what makes it a Canadian favorite. But when we look at the dividend payout ratio, it sits at around 187%. This also looks incredibly high, but the general justification that the market gives is that their future cash flows make up for it. Honestly, I'm still doing my research on it and I encourage you to do the same. Looking at the analyst consensus on tip ranks, it shows a moderate buy with an upside of about 20%. The price target is close to $56 over the next 12 months. The fundamentals look negative right now, but the general sentiment seems to be bullish on this stock. Even with such a high dividend payout, a lot of Canadians are skeptical about this purely because energy is such a volatile sector. Indeed, Enbridge has been a candidate for my portfolio for a while and I'm still researching the sector and the impact of such a high dividend payout. Enbridge is also raising capital through debt, so that's also a consideration. Do you currently hold Enbridge? Tell me in the comments. I will make sure to make an update video when I add it to my portfolio. And by the way, if you enjoy this kind of content, make sure to subscribe and hit like if you have found this video useful so far. Next on the list is TD Bank, ticker symbol TD on the Toronto Stock Exchange. We all know that TD Bank is a major financial institution in Canada, but they also offer various financial services. It is one of Canada's largest banks and their services include banking, insurance, and wealth management. It's headquartered in Toronto, but they have a strong presence across North America, in Canada, and the United States. Millions of customers bank with TD and they're able to serve them with their massive network of branches, online banking, and mobile apps. Now, taking a closer look at the revenue breakdown, we see that the personal and commercial banking industry in Canada forms a large portion. Next is the US banking customers, and corporate clients also form a small portion. But they also have a massive wealth management and insurance business. Now, looking at the company financials, we see that as of August 22nd, it was trading around 82.50, down about 7% year to date. The market cap sits around 151 billion and the price to earnings ratio is about 10.5. This actually comes in a little lower than the Canadian banking sector average, which hovers around 12 to 14. Now, although not as high as the other two stocks, their dividend yield is still about 4.5%. But their dividend history looks amazing. They have consistently paid dividends over the last 33 years and the dividend has grown consistently over the last 12 years. And even the payout ratio sits at a healthy 46.7%. The analyst consensus on tip ranks currently shows a moderate buy with an upside of about 11%. The stock price target over the next 12 months sits around 91.5. And the fundamentals are not up for debate because it is considered a systematically important bank in Canada. TD is actually the latest buy in my dividend portfolio. I waited for a good price and now that it's down about 7% year to date, I felt comfortable starting a position. But also I encourage you to do your own research. This is a good time to tell you that I am in no way capable of giving financial advice and this video is only for information purposes. Please do your own research and make sure to consult a financial advisor if you need to. So those were the 3 stocks that I wanted to talk to you about today. And as I said earlier in the video, we will look at the other stocks in the upcoming videos. And I hope you keep building your portfolio till then. Keep learning and stay on top of your finances. Until next time.